Hello everyone. I am going to attempt to explain how taxes work. I know that's kind of a complicated subject, but it's something that a lot of my bookkeeping clients ask me about, and I often have to have this conversation explaining to people how taxes work, so I figured I would use this opportunity to explain it. So we're going to start here. This is looking at the sources of income that people have. So if you are filing a tax return, it's because you earned income that you need to report to the IRS. So you see here, step one is income comes in to the taxpayer. Whether that income is from a job that you work or from self-employment, a business that you own, could be an inheritance or alimony or unemployment income. Somehow it's money that came to you. Now in a business, you have different revenue sources, whether you've sold assets, received donations, gotten loans from a bank. If you put money into the company or if you made sales, hopefully sales of your products and services is where most of your income is coming from. So the money flows into the business, as you can see here, and then the money flows back out of the business. And when the money flows out, it's either going to flow out as an expense, like salary or advertising or supplies, or it's going to flow out to you. Over here, owner withdraws the money. So when you are looking at this here, the different sources of income, this self-employment one, this is going to be your net income, the amount of profit you actually made or the amount of money you were able to take out of the company. Once that income comes in, you need to report it on your 1040 form. So let's look briefly at the IRS 1040. Now you may know, you may not know, there are two kinds of 1040 forms. This is called the 1040EZ, and this is just a standard 1040. There is a difference. The 1040EZ, just like it sounds, is for people with very easy tax returns. So typically, if you're a small business owner, you wouldn't use this 1040EZ. If you own real estate, if you have a piece of property, you would not use the 1040EZ. And the reason is, on a regular 1040 form, there's a lot more things that you can deduct and a lot more places for you to put in your different income sources. So on a 1040EZ, you see there's only 6 lines in the income section and 5 lines in the payment, credit, and tax section versus a regular 1040 that has, 15 different lines just for income. So more complicated people, more complicated returns. So this is the standard 1040. So you see this top section is income. These are all those same things that I was saying where money flows into you, just like this one, and then it gets reported. So here's the place where that gets reported. So if we're looking at your wages, that's an easy one because you should get a W-2. If we're talking about business income, this is line 12. You see it says attached Schedule C or C-EZ. Well, we look at a Schedule C, that's this one, IRS Form Schedule C. This is the form that looks very much like what you might call in business a profit and loss statement or an income statement. The top section has your total amount of money you brought into the company, gross income, they call it. You see gross. So that's just the amount before you take anything away. So if you earned $100,000 in gross, you would just put $100,000 there. So this next section, the expense section, is where you get to tell the IRS how much of the money that you earned did you have to pay out for things in order to keep your business operating. And that could be advertising, it could be salaries, it could be mortgage that you paid on a building that you own, legal and professional services like bookkeeping or attorney fees, office expenses. There's a line for rent here, rent or lease of vehicles, vehicles, machinery, and equipment. You also have repairs, supplies, taxes. You can see all these different categories. And then there's also an other expense that there's another section down here for other expenses. So there is a place for you to put all the things that you spend your money on. Now what I usually coach my clients to do, and the way that we set up our QuickBooks files, is we use all of these categories as our main headings in their QuickBooks categories so that when it's time to file the tax return, it's easy because the numbers that we need to put in these little boxes already have these headings, so we know which ones to put where. So once you have made all of your deductions, let's say that your total expenses for your business end up being $65,000. Now, I will tell you the IRS will see it as a red flag if you have round numbers like 65,000 as expenses, because normally it wouldn't show up that way, nor would your gross receipts typically show up in round numbers like this. But let's say for our purposes that's what we're doing. So what that would mean is 100,000 gross, 65,000 in expenses. Line 31 is going to be 35,000. That's going to be your net income. So on your 1040 form then, on line 12, that's where your 35,000 would go. Pretty easy, right? Just taking the money from the explanation of how much money you earned and then transferring it over here. Now with self-employment, there is something that you also need to know about, which is your self-employment tax. 15.3% of the profit that you earn, of this $35,000 in this case, is supposed to go to the IRS in the form of self-employment tax. And essentially what that means is when you're an employee, you're earning wages, right? And they take money out of your paycheck. Well, if they take money out of your paycheck, then you wouldn't be expected to then take more money and send it to the IRS, because that's already been done for you by your employer. Social Security, Medicare, and what's called FUTA, unemployment. So those are the things that you need to get taken out of your paycheck. Well, when you're self-employed, that doesn't happen. So the IRS expects you to take 15.3% of your profit, this $35,000, and send it to them. And you'll see that right down here in this bottom section, there is a line that says 1/2 of self-employment tax that you are allowed to deduct off of this bottom section here. Line 27, deductible part of self-employment tax, and do you see it says attached Schedule SE? This SE is the form where you figure out what 15.3% of your income is. And then half of that you get to deduct. And the reason is because employers pay half and the employee pays half, but when you're doing it all yourself, you have to pay the whole thing. But they don't expect you to pay income tax on your self-employment tax, because that wouldn't be fair. So you would have your self-employment tax. It gets reported here on line 57. Here's your self-employment tax. Again, it tells you to attach your Schedule SE. So you put the total tax here. Half of it gets deducted on the first page on this line 27. I know this may be a little bit confusing. This is all stuff your accountant takes care of, so it's not really something you need to worry about, but it's good for you to understand how this works. So we're looking back here at our Schedule C. This is where we report the income. Now, what if you're a corporation? Well, if you're a corporation, you're going to have an 1120 instead of your Schedule C. Okay? If you are a partnership, you're going to have a 1065. Instead of an 1120, instead of a Schedule C, you'll have a 1065. If you're a C corporation, you'll have this 1120C versus an S corporation, which has an 1120S. Now, all it means to you is it's a different form for reporting how much was earned and how much was spent. At the end of the day, you're going to be left with the same thing, which is the amount you took out. The only difference is on a corporation and on a partnership, the amount you take out comes out as what's called a K1. Do you see here this compensation of officers? So your K1 is essentially kind of like a W-2. It's kind of like a 1099. It's just a form. Here's your Schedule K. This is different than your K1. It's just a form. Let me show you what a K1 looks like. This is your 1065 K1. This is a Beneficiaries K1. We'll look at this one. Okay, so K1, see, partner's share of current year income. So this is essentially just showing how much money did you get to take out of the business and how much did your partner get to take out of the business. The same thing happens on an 1120. The same thing happens here on this 1120. It's no different than your Schedule C. So that amount transfers over into your income section, your K1, And I have to say I don't remember which one of these lines it is, so let me look here. Must be line 17, where it's asking about your partnerships, S corporations, trusts. We can look at the Schedule E. Whoops, Schedule E. Yep, here we go. Income or loss from partnerships or S corporations. And then down here you're putting the name, and then here's your K1. See? Passive income from Schedule K1. So your K1 transfers to your Schedule E. And keep in mind, I'm not a tax preparer, which is why I have to look this stuff up. So your K1 transfers over to your Schedule E, and then your Schedule E transfers to line 17, where you would put how much you earned on your K1 if you were a partnership and you got $35,000 out of the business. That $35,000 would just go here instead of on line 12. So either way, the income is going to come over to this top section of your 1040. So once your 1040 has the income in there, the next thing we want to look at is the expense section. So essentially, tax and credits is the equivalent of the expense section for your tax return. So you remember, hopefully, in your Schedule C we had the income in the top, then the expenses down here, leaving you with the total expenses and your net profit. Well, the same thing happens on your 1040 form. It's just called something different. So your income goes into the top. There are some adjustments, like I showed you. And then in this next section is where we do taxes and credits. Okay, so then the taxes and credits section, this number carries over from the previous page. So let's say that we're still working off of our $35,000. I'm going to skip the deductible part of your self-employment tax for now because it's just not relevant for this conversation. So let's say that you're working with a $35,000 net profit that you earned in your business. You see this line 40? It says itemized deductions from Schedule A or your standard deduction. What this deduction thing is trying to say is we're the IRS and we're friendly, so we want to leave you enough money to pay your bills. And then we don't want to tax you on that money. We'll just tax you on everything over the amount it takes for you to pay your bills. So the way they do that is they give you a standard deduction. Do you see over here it's $6,200 for single, or $12,400 if you're married filing jointly. So you get to put that number here if you're married filing jointly. And then this $12,400 deducts right off your $35,000. So you don't pay tax on $35,000. You're going to pay tax on $35,000 minus the deductions in this section. So that's one deduction that you get, and then this next line here is just the simple math. So they're just taking $35,000, and I will get my calculator out to do this. So they're taking $35,000 and then deducting the $12,400 from that, leaving you with $22,600. So here we now have our net after just our standard deduction. Now the next one is your exemptions. And this one here, you get $3,950 for each person, essentially, that your income supports. So if it's you, your wife, and 2 kids, that's 4 deductions. It can get a little bit tricky when you get into teenagers because they have to be living at home and you have to be supplying more than half their income in order to be able to count them, or if you have, if it's a divorce and you have a child that you share custody with, one person gets to claim the child 1 year, somebody else claims them the next year. Sometimes they do it that way. Either way, let's say you're just you and your spouse. So it'd be $3,950 times 2, which is $7,900. So that's another deduction that you get to take. Now we're deducting it off of this $22,600. which leaves you $14,700. So this $14,700 is the amount that you're essentially going to pay tax on. You don't pay tax on the $35,000. So now let's look at the difference here. What the IRS is saying is that of the $35,000 you were able to make in profit from your business, $20,300 of it is not taxed. Only the $14,700 is taxed, which tells me that really what they're saying is $20,300 is how much we're giving you to live. And when you divide that by 12, what you find is that's $1,691 a month of this person's income that's not taxed. And then the rest of it is. Well, we know that $1,691 is probably not enough money for two people to live for a month. And so one of my contentions is that this deduction and the way the tax is done is completely unfair based on our current economy. But it's a topic for a different conversation. So now we're going to take this $14,700 and we want to figure out what our tax is. Well, all you have to do is go to this very long document here, which is called your 1040 tax table, and you scroll down in the tax table looking for this number, $14,700. So it's going to be 14, and then you see it goes by, there's our 14,700 here. And then these four columns are married filing jointly, married filing separate, single, and head of household. So married filing jointly, you're going to scroll down to 14,700, and the tax is $1,473. So which is what? Almost just about 10%, right? So you go 1473, that's your tax. We're not going to cover every line on the tax return because this is really just trying to show you how this thing works. So at the bottom line here, these are credits. So if you had a job where you had a W-2 that got put against your tax, you would be able to put that in here. But in our case, we're just going to say that 1473 was your tax. Now remember what I said, if you're self-employed, you also have self-employment tax, which is 15.3% of your net profit. So you would, in addition to that, you would have 15.3%, which would be $5,355 of self-employment tax. It's essentially 15% of this $35,000. So we would take your total tax of $1,473. You would add to that your $5,355, and now you're at $6,828 is your total tax. So $6,828 on $35,000 is 19.5%. So you're basically paying about 20% of your profit goes to taxes here. So you've got your total tax of $6,828. Down here is any payments that you've made. You see here's W-2, so any money that got withheld by your employer. There's some other taxes and credits down here. And at the end of the day, if your total payments were zero, then you won't get a refund. And if there was no money paid in against that, then your total tax would be the same as this $6,828 here. Of course, anything that you already paid in towards this, like your self-employment tax payments you're supposed to make every quarter, would go against this. So that's pretty much how the tax return works. I hope that that has been clear, and if you have any other questions, please feel free to contact me.